Hello people, this is Dr. Wang here recording. In this class exercise, we're going to practice on capital assets pricing model, aka Capm. So what you are looking at here is the daily prices for securities. So we use Spider. This is an ETF for standard 500 index to represent the stock market. And then we have Apache Corporation stock, and we have Amarada Corporation, Amarada Hess Corporation, so the ticker is Hess. We also have a Foot Locker, so FL stands for Foot Locker, not Florida. And we're going to conduct Capm analysis. So the model we use here, based on your textbook, is the expected return equals to the risk-free rate plus the beta of the stock times the expected return of the market minus risk-free return. Okay, so this model is telling us there is a link between the market risk premium, which is the market return minus risk-free rate, and the individual stock return. Okay, so let's just calculate the beta first. All right, so the very first thing for you guys to do is to calculate the return, Control C, Control V, and we're gonna create an area for returns. And then we're going to use the later price divided by the earlier price and make sure the dates are in ascending order. And then drag it, double click, and then hit the percent sign, show some decimals. All right, and then we're going to do the analysis for the three stocks. So let me begin with Apache Corporation. So what we have here, so I'm just to insert a row, and this row is for the prices. Okay, and this row, this area for the column is for the return. And I can just put a raw return based on the prices. And then I'm going to copy paste, and this time I'm going to do the risk premium. To calculate the risk premium, I will need to use the risk-free rate. So I use the raw return minus the risk-free rate. I'm going to use the 5%, that's the prevailing risk-free rate, actually, 5%, divided by 252. That's the number of days, trading days in a year. Okay, so this is the risk premium for the market on that day. All right, and then I'm going to drag it to the right, and then double click, so I got the result, drag it down. Okay. So this is the risk premium, and to conduct a Capm analysis, we will need to hold the market risk premium as the independent variable and the stock risk premium as the dependent variable. So one thing you can do is to do data analysis. You hit data, and then you click on data analysis. If this function is not installed in the computer, then you will go to File, Options, and then Add-ins, and click on this Go button, and make sure the analysis 2-pack is checked. All right, and then you will need to click on the data analysis. You look for regression. It's right here. Okay, the Y values will be the stock's risk premium. Okay, the X value will be the market risk premium, and then you hit OK. Nice and easy. All right, so right here you need to name it as APA. Sorry, I have done some exercise in between, so let me delete that one. So you're gonna name this as APA, and you will need to focus on several things as explanation, as this will be tested. Okay, so you need to read R square, the coefficients of intercept and X variable, and also the p-values. Okay, so the regression is pretty good. So the R square is 26%. So that means the X value can explain the Y 25%, 26% of the Y values. The market can explain 26% of the stock returns. So that's a high power of explanation relatively. And if you look at the coefficients, the intercept is actually has a name. It's called alpha, and the name for the coefficient of X variable is the beta in the Capm analysis. Okay, you can see that beta is 1.45. So that means when market move by 1%, the stock move by 1.45%, okay, or in the same direction. If the market is moving down, then the stock is moving down as well. All right, and the stock moves more than the market. So if beta is greater than 1, that means the stock is more risky than the market. You see, when the market fluctuates by 1%, the stock fluctuates by more than 1%. All right, so that's something you need to know. And also, the coefficient is a pretty close to 0. Then you will need to check the p-value. So the p-value has a threshold. Let me use the 5% as the threshold here. Oops, 5%. So right here, let me just convert it to percentage. So you can see that the p-value for alpha is 40%. It's much higher than 5%. And that basically means this alpha is insignificant. So that means there's no statistical evidence to show the alpha is different from 0. So this alpha is insignificant. So there's no intercept in the regression analysis. And for the beta, it is less than 0.000%. It's definitely less than 5%. So the beta is a very, very significant. Okay, so this beta is definitely not 0. It is 1.45. And for you guys, you're gonna perform the regression analysis 3 times for each of the 3 stocks, not only for APA but also for Hess and Foot Locker. And you will need to have another 2 spreadsheets established here. Make sure your X value is the market risk premium and the Y value is stock risk premium. Okay, and you're gonna do that by yourself. I'm not gonna do that here. You will do it. Okay, what I will teach you is the easier way to calculate the beta. This is a very comprehensive way showing you the value of alpha and beta significance and the goodness of fit for the model. But just to calculate the beta, it is actually fairly easy. Control C, Control V. So you will just need to use the slope function. Okay, and it's going to ask you what are your Y's. So the Y values would be the stock risk premium, and the X value would be the market risk premium. Hit enter. Okay, so this is your beta for APA. And for the other 2 stocks, you just log the market risk premium, the X values in the slope function, and then you just drag it like this. So you can see that you have changed the Y values, but the X values stay the same. All right, so these are the beta for the 3 stocks. And you can also use the third way to calculate the beta. The third way requires some skills in charting. So you will need to insert, first of all, place your mouse in the blank cell and insert a chart. And you're gonna insert a scatter chart like this. Okay, and you will have one chart. It's a very blank chart, and then you're gonna right click on this chart, select data, and then you're gonna add a series, and this series I just call it APA. All right, just click on it. The X values would be the market risk premium, Control Shift down arrow, and then the Y values would be the risk premium for the stock. Okay, and then you click on OK. All right, so now you have all the data points plotted in this chart. So each data point is one particular day. And the X value is the stock return risk premium on that day. The X value is the market risk premium on that day, and the Y value of the point is the is the stock risk premium on that day. All right, and then you will need to do add trend line. Right click, add trend line. Okay, and then you will need to define the trend line, and you just go with display equation on chart. And you can also display the R square, which is a goodness of fit. Okay. All right, so upon clicking on that, you will find out this is your data with the function of Capm. So the Y value is the risk premium of the stock. The X value again is the market risk premium, and then the 1.4526 is the beta. That's the linkage between the market and the individual stock. And this 0.0017 is the alpha, but it's statistically insignificant. And R square is 0.2641. As you can see from the distribution of your data points, the daily data is showing you if the market is going up. When the X value go up, the Y value start to go up.